Ladies and gentlemen, once again, welcome to the Think Clinical podcast. My name is Hamza. It's always a pleasure to be here. I appreciate each and every one of you for the time you spend with us every time. And today, just like we've been doing over the last couple of weeks, we will be going through and still trying to understand some very, very basic concepts in accounting, in finance. Just properly positioning ourselves for a conversation when you get into the healthcare entrepreneurship space. Things you hear, things you need to be aware of, things you need to be very familiar with and understand. Even though a lot of the time, especially for those of us who moved from like a medical field into business, there are actually terminologies that are thrown around that we really do not understand. So it's important that we get ahead of these and actually be part of that conversation and be present for those conversations when they happen. And today is going to be a very short video, but I'm going to be walking through what debits and credits are. When you hear that something was debited and something was credited, you should be able to understand exactly what that means. If your accountant comes to you and starts using those terminology, you should be able to follow that conversation, because it's your business, so you have to be able to understand some of these very basic terminology. And this is just very, very basic stuff that you need to always be aware of. So first of all, we need to clear some misconceptions. And sometimes a lot of people think debits and credit one should be good and the other should be bad. That's not the situation. So that's one misconception that we need to discard as soon as possible. And we also need to understand that debits and credit does not translate into the fact that we are adding or subtracting something. So for you to be able to properly understand this concept, you need to discard these misconceptions that one is good and one is bad. And you need to also understand that it doesn't mean one is is the same as adding or subtracting something from any form of transaction. So you do realize that there's a double-sided nature for financial transactions, and before you be able to for an economic benefit, which I will explain in a bit, to move from one place to another, or for you to have money in one account, it must come from another account. So there is this duality to financial statements that these terminologies speak to. So this is just basically telling you that if you are moving money, if money is present in one account or is being moved to one account, it obviously came from somewhere else. And credits and debits are your way of tracking the source of this economic benefit and the destination of this economic benefit. So basically, anywhere that you move an economic benefit from, or any source that you move an economic benefit from, it becomes a credit. And anywhere you move it to, it becomes debited. So the destination where you move that money to becomes the destination. Where you move it from, or the source from which you move that money from, it is credited. That's where the credits hit. So what do we mean when we say economic transaction, economic benefits? So when you have an asset that has the potential to contribute either directly or indirectly to the flow of the entity's cash, or for your company's cash, if it has any ability to either directly or indirectly contribute to your entity's cash, then it qualifies as an economic benefit. So economic benefits would always move from a source, which is where they are credited from, into a destination where they are debited to. Now, the destinations usually, again, is where you have the cash or the economic benefit is flowing to. And when you look at the balance sheet, and when we went through the balance sheet, we spoke about assets. When we looked at your income statement, we talked about expenses. When when we looked at your balance sheet, we talked about dividends, which is the cash to the owner, right? These are destinations to which money can flow to. These are debits. So when you have an asset, you are usually moving economic benefits to those assets. Expenses, economic benefits flow to those expenses. Dividends, any cash you pay to owners, economic benefits flow to them. So these qualify as destinations or debits. Now, when you talk about the source of an economic benefit, that is where the money or the economic benefit is moving from, which means that if you look at owner's equity, if you look at which is on your balance sheet, if you look at your liabilities, if you look at your revenue, this is where the money is moving from, which is the source. So you are crediting these sources and moving them into your destinations, which can be in the form of getting new assets, which in the form of paying for expenses or supplies that you've used, which could be in the form of paying cash to owners in the form of dividends. So you could move or when you look at in other words, it's always important that we revisit the accounting equation, which says that your assets, which is from the balance sheet, your assets should be equal to your liabilities. Your assets on the left side of the balance sheet, they should be equal to your liabilities plus your owner's equity, which is on the right side of the balance sheet. And this means that if you want to break it down even further, we already said that your assets are destinations, and destinations are debits. That's where economic benefits are flowing to. So these are already debits. That's your assets, and that's equal to your liabilities, which we said are sources where an economic benefit flows from. So your assets, which are debits, will flow to your liabilities, which are credits. And then what happens to your owner's equity, which is also on the right side of your balance sheet? Your owner's equity, or your equity, will now be equal to your owner's equity, which is paid in, whatever the investors put into the company, minus the dividends that is paid out to these investors, which is in the form of which are destinations, and then destinations are what? Debits. And then you are going to add on to your retained earnings, which are also again on the right side of your balance sheet. So if you put this whole equation together, you're now going to have assets, which are debits, being equal to liabilities, which are credits, plus your owner's equity, which is how much the owners have put into it, less of dividends, which are what you pay out to the owners, plus your revenue, and plus your expenses. If you break it down, if you pull out your, if you stretch out your retained earnings and make it a general equation, and then rearranging all that, you are now going to have all your assets. You're going to have your assets, your expenses, and your dividends on one side of the equation, and you're going to have your liability, your revenue, and your owner's equity on the other side of the equation. So expenses and dividends now qualify as debits, which are again destinations to which economic benefits flow to. And then on the other side, you're going to have your liabilities, your revenue, and your owner's equity, which are sources from which economic benefits flow from. So then you are now going to have that balanced equation. If you ever want an easy way to remember this, and anywhere you go, the abbreviation that is used is dealer. D-E-A-L-E-R. DEA on one side, which are debits, and then LER on the other side, which are credits. So again, this explains the duality of any financial statement, denoting where money is flowing from, which is the source, or where it's credited from, that's the source, and where it's flowing to, which is the destination, or where it is debited to, and that is dealer. DEA, D for dividends, E for expenses, A for assets, all qualifying as debits, and debits are destinations, that's where they flow to. And then LER, which is your liabilities, which is your owner's equity, and then your revenue, that's where they flow, which are the credits, which is the source from which these economic benefits flow from. So this should be able to help you, and I try to make it as simple as possible to just understand basically what credits and debits are. And when you're looking at your financial statements, you're looking at your income statements or your balance sheet, you should be able to understand where your economic benefits are flowing to and where your economic benefits are flowing from. So this has been another very exciting episode. Always great to be here. Thank you so much for the support you give to this channel, and we will see you again in our next episode.